Welcome to this week's episode of Ben's Market Insights. This week we're going to talk about three key factors. One is the likely peace plan that is being drawn up between the US and Iran, and what we think from a market perspective are the key elements to be looking at, and what will be discounted and what will not. We'll also look at Kevin Warsh. He's now the appointed Fed governor, and we'll see what tools he has in place and what he's likely to do in the near term. And then lastly, we'll take a protracted look at Bitcoin, why it's underperforming and why we think it's that potentially is now a structural issue for Bitcoin, not a cyclical factor. Okay, if you're enjoying this content, please subscribe and like to our YouTube channel, Ben's Market Chat. So let's jump in. So the first thing that we really kind of want to think about is, from the potential peace plan with Iran, is what are the key factors that both sides need to think about or are thinking about. Certainly the opening of the Straits of Hormuz is one, uranium enrichment and the stopping of, from a US perspective, is the other. And then other factors, including Iran's requirement for reparations for damages caused by the war, unfreezing of billions of dollars worth of Iranian assets abroad. The other elements that fall into this as well include, of course, Israel and their war with Iranian proxies and what would happen in those scenarios. I think the key things from a market perspective is clearly the opening of the Straits of Hormuz. There are also in that process potential issues around tolls. What's interesting is when the Iranians were talking about that yesterday, they were discussing it in terms of services provided to shipping coming down the lanes, including preservation of the ecology, which is quite an interesting way of masking, if you like, the toll issue and making it sound more acceptable. So I suspect the key elements are that the immediate impact would be the removal of the US blockade, the removal of the Iranian stoppage or lifting of the Straits of Hormuz issues, and of course removing mines from that area and allowing the free flow of product and oil, of course. We still think that's going to remain inflationary, but nonetheless, the market has pretty much discounted most of those factors at this juncture. So overall, I suspect the outcome is a positive one. We get what the market wants, which is the free flow of trade. And then the other much more complex issues, including the issues around Israel, including issues around uranium enrichment, all of those elements are kicked down the road. And no doubt discussions around reparations go nowhere, and discussions around unfreezing of assets also bears very little impact from a market perspective. It's much more of an emotional issue back home. So good news on that front, but largely discounted. Now, Kevin Warsh is the new Fed governor. What does it mean for us from a market perspective? Well, let's take the latest inflation figures that are going to come out on Thursday. These are the PCE figures, which is what the Fed looks at most closely. The consensus expectations are something like a 3.2 to 3.4% number year on year. That's an increase of 0.3% on March. Clearly way off the Fed long-term target of 2% inflation. And I think it's also worth keeping in mind that the effective lending rate at the Fed today is around 3.6%. So there's really not much room for further declines or further reductions in the Fed rate. In fact, if another 25 basis point reduction could, in theory, bring real rates to a negative or nil vicinity, which is in not particularly something that the administration or the Fed wants to see happening, certainly not the Fed. 10-year is reflecting this inflationary issue. Last week we saw a peak of 4.7%, which is pretty much at highs. recent highs, currently at 4.5, but could spike again if that number on Thursday comes through at the upper end of the consensus estimate, or potentially even higher. So even Kevin Warsh, trying to please the administration, won't be able to reduce interest rates straight away, but he does have a few tools that he can play with to continue the expansionary mode and keep the administration at bay, including reducing the reserve requirements of banks in terms of allowing further liquidity for lending. They could also reduce the interest rates on deposits that banks have in the Federal Reserve. And again, that means that there's going to be effectively a substitution effect, and banks will look for other sources to lend into for a better return and yield. That again creates further liquidity. And also the central bank could reduce the emergency funding rate, and again that would allow for further liquidity as cheaper money comes into the banks to be able to lend out on. So there are tools to increase liquidity that doesn't need the FOMC to rule on. It can be a unilateral exercise by the Fed governor and his team. But nonetheless, I think that it is worth keeping in mind that the long-term likelihood is that with these expansionary tools in place and likely to be used in some form or fashion, we're also going to see an interest rate cut further down the line, depending on what's going to happen from the sort of transitory or not element with the oil price. Yet to see, but the bias is certainly for increased expansion and increase in liquidity, which is clearly positive for risk assets. Moving on to Bitcoin, I think it is worth keeping in mind that we've really not seen much of a performance out of the crypto marketplace. So Bitcoin's down some 12.5% year to date. Ethereum is down almost double that, 25%. But I think what's actually even more concerning for crypto investors is that volatility has more than halved since the period between 2017 and 2021. And I say that that's a big issue because it's transforming the way I think investors start to look at Bitcoin. For me, Bitcoin has effectively come out of its teenage years, is a young adult, and now significantly maturing. And there are a number of, I think, structural factors that are affecting how Bitcoin is going to get traded going forward. As a maturing asset class, I think to some extent that veneer of being a non-boomer asset, that it is somehow a protest asset for millennials and younger investors to sort of introduce the new digital currency, the decentralized finance and non-government controlled asset class, which basically traded outside of the system. That's kind of pretty much gone now. It's also worth keeping in mind that some 10% of the free float of Bitcoin is now owned by institutions in the form of ETFs, in the form of actual pension funds owning the asset. And they don't trade very much, but they also have a very much more conventional perspective of how an asset should trade. I also think that the FOMO, the fear of missing out element is in a sense becoming more and more of an issue in the rearview mirror, because as an asset class becomes more mature, its cycles become a little bit better known, and people understand that if they are missing on a peak, they're likely to be able to re-engage with the asset at a later date. Up till now, or up till sort of a couple of years ago, that wasn't the case with Bitcoin. It was, if you missed the nearest peak, you're really likely to miss the next one as well. So that feeling, I think, has now evaporated from the marketplace. The other element is around stablecoins. Now, stablecoins have really grown significantly in the last couple of years. The market cap is something like $350 billion today. Compare that with $1.5 trillion market cap for Bitcoin. So still 20% of the market cap. But stable coins in their various forms do trade significantly more than Bitcoin. They are much more of a utility asset, are used significantly by corporates and institutions, and so therefore are, I think, likely to have a significantly competitive feature to Bitcoin as a store of wealth, if you like. Also, I think the current administration have been very actively creating regulation to bring Bitcoin into the established conventional family of assets, if you like. And I think that in some respects that's not in the favor of the asset class itself. There is an element of wild market about it that I think will go, and the more regulation that comes to Bitcoin, the less attractive it becomes. And it kind of goes back to my first point about this maturing asset class issue. And the last point is a mechanical, technical issue around this concept of halving, that every couple of years that there is a multiple by which new mined coins come on stream. So there are literally at the moment some 20 million of the 21 million available coins that have been mined and available. But the interesting thing is, as we head towards that final million in terms of being fully mined, it's worth keeping in mind that the halving multiple gets smaller and smaller, so that by 2140 we get the next million being mined and produced. And so in fact, this tension that we've seen in recent years as the halving process allows for more coins to be brought into the marketplace, that disappears, and we now have a very long period for which the next million will come through. So that takes out some of the tension in the marketplace. Overall, I do think that Bitcoin is becoming conventional. I do think that its performance will be much more mirroring, if you like, the Mag 7 or technology. Its reflection of risk on and its underperformance is a reflection of risk off. And the volatility is the key element here. It's going to become a lot less volatile, and I suspect a lot less interesting for new investors. Have a wonderful week, and we'll see you next week.